Welcome to Scalpers University Module 3, Price Action. So this is the part you've probably all been waiting for, where we get into the ins and outs of market structure, how I actually trade based on, the candlestick charts, I suppose the easiest way of saying it. So this module is all about that. It's about candlestick charts, liquidity, and the most important concepts, in my opinion, regarding how to actually trade on low time frames. As the nature of markets is fractal, every lesson I teach here also applies on all time frames. So, like I say often, Scalpers University is not just for scalpers. It will give anybody a great grounding into how to trade better. So the lessons for Module 3 are as follows. Market structure, which we're about to get into now, which is the core fundamental of all trading, in my opinion, and basically is consensus within the market. Market structure, which we'll talk about, is basically higher highs and higher lows and vice versa to indicate trends. And trading those has been the most consistent and profitable way to trade. And then on top of that, you want to add other confluence factors such as the other lessons, 3.2, mean reversion, 3.3, liquidity, 3.4, chart patterns, 3.5, indicators. So if you want to look at it this way, market structure is your grounding. That's your first principle. That's your North Star. Always focus on market structure to begin. Then tag on your confluence factors, such as 2, 3, 4, and 5 that I've mentioned there, or whatever other factors of your own. Add those to your market structure base. But it should always start with the base of market structure. Where we are in any type of trend, market structure will tell you. So let's get into it. 3.1 market structure. So to begin, here's a very basic but informative overview of what market structure is. So, on a very surface level sense, if you're making lower lows and lower highs all the way down here, so each time you're making a new low, you're making a new high, you're making a new low, you're making a new low, you're making a new lower high, you're making a new low, a lower high, a new low, a new lower high. Doesn't matter how much the bounce looks or how strong the bounce is. If it doesn't break above this dashed line, which is the previous high, it remains bearish. We'll talk about the mechanics of that in a second. And on the flip side, bullish is where you're making this low, a lower high, a lower low, a lower high, a lower low, a lower high, a lower low, but then you make a higher high, higher than the previous high, which led to the lowest low. That is the first sign of a bullish structure break. All right? So this is in terms of continuation or reversal. If you flip this, it applies just as much for an uptrend flipping to bearish. So you'll hear me talk about certain things, certain key terms. You talk about bullish and bearish market structure breaks, and they can happen on all time frames. On the left, we have bearish continuation. We have no market structure break. Okay, so for a trend to reverse, you must have a break in market structure. What a break means is that it's broken the downtrend and potentially reversed, like we have here. Broken the downtrend and means we can potentially reverse. So that's what you want to focus on when trading market structure. You want to focus on an existing trend, so spotting an existing trend, setting your highs and lows, either higher highs and higher lows for an uptrend, or lower highs and lower lows for a downtrend. Then you want to, on the time frame of your choice, chart and set an alert for when you get a break in that structure. That's your first signal that on that time frame, the trend is reversing. Now, it will matter massively whether that's on a daily time frame or a 1 minute time frame. Okay, you can't just trade every 1 minute break in structure because it happens multiple times per hour. So you'll learn as a scalper to use higher time frames to frame your bias, something like a 1 hour chart, and focus on the structure breaks within those. If you focus always on daily market structure breaks, which is the best way to trade, is the best way to get a sense of where the market's going as a whole. But as a scalper, the daily structure doesn't break regularly enough for you to get trade setups. I'll talk now about the mechanics of why this happens, and then we'll go into an actual chart to really nail it down. So when price is coming down, in the example here in the red, as price comes down, it's the only way the price can move is through aggression in terms of market orders, which is also called taker flow. All right. For when you execute a trade, you can either execute with a limit order or a market order. For anyone, and please God, if you're on module 3 of Scottish University and you don't know the difference between a market order and limit order, may God have mercy on you. But you know, as you're a smart trader who's got some experience, you know that a limit order can never move price. All right, so you have to wait for price to come to you with a limit order. You set a limit order at 36,000 for Bitcoin. It won't fill unless price gets to that level. You set a market order. You just take whatever the best price is at the moment and you set your size. Say you want to buy 1 BTC. And after it, you only find out after executing what the actual price was. Because depending on the liquidity on the books, it might execute at 36 or it might slip. It might end up executing at $36,050 because your 1 BTC order had to go through the books to fill itself. So by the very nature of that, the taker side is what moves the market. I hope that makes sense. Taker side moves the market. The maker side, which is the limit order, it sets the key levels of support and resistance, but it's only the taker side that will continue to move the market until it reaches sufficient support or resistance to reverse. So what you're seeing here is taker orders pushing us down, taker orders pushing us down, taker orders pushed us all the way down here, obviously then met some support, which is in the form of a large wall, probably of limit orders. And then when we start to reverse, as we start to move back up, how can price move up? It can only move up with taker orders on the buy side. So the buying pressure is now overwhelming the selling pressure, meaning that we're moving price up. Now, if you have this large gap down, it then gets absorbed and you push back up, but you fall short of that previous high, then you can assume that the taker flow, which is the buy market orders, are not able to overwhelm the previous taker flow from the sell market orders. So that means whoever was selling all the way down still has a stronger hand than whoever is buying it back up. It doesn't matter who is doing it. You'll hear people talking about the market maker, sweeping liquidity, stop runs, liquidation hunts, whatever you want, or stop hunts and liquidation runs, whatever you want to call them. Don't worry about that, because again, that's just getting too much into the woo-woo psyops of market manipulation and stuff. All that matters is the market as a whole, the entirety of the market, because it's never just one person, the entirety of the market, sell orders, was able to push price all the way down to here from a high of up here. The market buy orders on the reactionary bounce were not able to break that level. Therefore, sellers are still in control, you can assume, and price is most likely to continue downwards. Does not mean it's 100% likely to happen. Of course, this could be a bear trap and it could pump right through. But as a rule, you want to look at how price reacts when it revisits that area. And if it starts to show weakness, you can say, okay, sellers are still in control. On the contrary, here we've buyers very clearly in control, as the sellers who sold down into here got squeezed aggressively with the market buy orders easily clearing the market structure level, and you would expect this after some consolidation to continue higher. So that's market structure basics as an overview. So now let's look at it for Bitcoin itself. All right, so I'll pick an example of a nice clear indication of market structure. And market structure is also related to Dow theory. If you want to read more about Dow theory, which is just, the very basis of Dow theory is higher highs and higher lows. So literally, this is an uptrend, okay? Where price goes up, it doesn't take out the lows each time. It makes new highs each time. And then, I wanted to do a downtrend, which is the exact opposite. Okay, super basic. there is no need to overcomplicate it. Okay, that is exactly what Dow theory is. That's what market structure is. That's what every trend we're in is. The only thing that differs is the time frame and how you interpret it. You see this move, and then suddenly it breaks like that. You think, oh, right, maximum short. But what time frame is that on? This could be on a 15-minute time frame within a broader uptrend on the weekly or the daily. And what you're seeing in that trend here is just this little blip in the radar here. It doesn't actually come anywhere near taking out the market structure on an important time frame. So keep that in mind. That's why if you get a perfect entry on a 15-minute market structure break or a chart or whatever, you cannot expect that to run to a key high or a key low. You can't expect to nail an entry like that and you've caught the very bottom and the very top of the macro bull cycle or the macro bear market. All right, so keep that in mind. Now, daily chart, looking at Bitcoin from December of 2020 into around February. Where's it going? February of 2021. So let's take a look at this. Right. We'll consider this trend starting after the all-time high breakout. So Bitcoin was here back in December 2020, then it broke out of the all-time high, the old all-time high, and began a bull run. Okay, so that's the level that we're looking at. So what do? Well, you want to set highs, which I'm going to set as trend lines in orange. Okay, so you're constantly setting your highs, and then you're setting your lows that led to the break in structure. So on a daily chart, I'll zoom in. You can see here this low, which is a down close candle, right? On my chart, white candles are down, blue candles are up. So the last down close candle, which led to a break of structure bullishly, which is to break a key high, right? The most recent highest high, that is your new market structure level. So you can very simply set this and say on a daily chart, we are bullish in a market structure perspective until 17,572 breaks. Okay, very simple. The reason it's this one is because it's the last down close candle before the break. That means every candle that came after it, no matter how small or big it was, every candle that came after it was an up candle that then broke through. Okay, last down close candle that broke the high that was the previous highest high that was set. Then what do? We wait for another local top to form. So what you're doing as you go along is you're constantly setting your highs. And you see here that we have a high that's set. We have price break down a little bit. We have a couple of days. Remember, these are daily as well. You have plenty of time. We have a daily one that sets. And then we have a green day after a down day. All right, so we have a red day, then a green day. At that point, you're looking at this to potentially be the market structure level. You wouldn't set it as that. The market structure level is still here. But say potentially. You get a green day, you say, oh, this might be the low. Turns out it's not because we have another down day here. Then what do? We get two green days that break the high. Therefore, this becomes your market structure level. So we set it. And you see the last down close candle before the break in structure to the upside. All right, it broke the highest high. Then we set a high, a really big high on actually a down day, and a pretty bearish looking candle from first glance. But still, we set another high, and then we drop back down, and we have a down close there. So we know this is our high. So we set it. And then we're looking for our low. So we wait. We potentially think this is the low. We get 1, 2, 3 green days in a row, which breaks the high. Closes above the high, which is important as well. Therefore, this is our new low. So what you're doing here as you go along is you're tracking an uptrend. So if I now just take my marker tool and draw between these, let's go all the way up to there. That's a pretty shit drawing, but if I'm able to turn off my candles briefly, you can see, visualize that this is an uptrend, right? That's all you're doing with this, okay? And it's just pattern recognition to be able to spot these highs and lows and to chart them out. So all you're doing is basically visualizing this, okay? Uptrend. Now what you're looking for then is a break in structure to signal a reversal of the trend, or you're using this to frame your entry for a your stop loss, for an entry. So, for example, now that you've broken this high, so as soon as this daily candle closes here, you have a down candle that leads to the break in structure. Now we know this is our market structure break instead of this one. So we've moved our invalidation basically up by quite a bit. That means if we're going to continue an uptrend, and when Bitcoin trends, it does tend to trend for a number of days or weeks, you can say, okay, I'm going to look for longs as soon as this breaks, as soon as that breaks, okay? I'm going to look for longs on a lower time frame, and I know that my invalidation is here. So now you know where your stop loss goes. So you're able to put your stop loss there, because if it breaks that, even if it sweeps it, if it tags it, we consider that to be potentially a shift in trend, and that's where your stop should go for a lower time frame trade. Then your only two questions are, can I get an entry? So we don't know where you're going to get an entry here. It depends on your low time frame setup. Can I get an entry that gives me a favorable risk reward return for a potential swing trade higher? And of course, none of this price action had happened before. This was all brand new at the time. So, and you're in price discovery, which means there's no price history above. So you don't know how high or low Bitcoin can go. But you at least know where you're wrong, and you can take a trade, and then you can set a target, let's say at least 2 hour. You say, okay, for me to get an entry here, when we dip back below, get an entry here, stop loss there, and my target is up here. Do I think Bitcoin can get to 32,000 in this next push? That's all you're really asking yourself. So that's a quick overview of market structure from a daily chart perspective. And I want to now look at how you would actually watch it develop in real time. Okay, not quite real time. I'm going to use bar replay, but let's see. Let's go back to here and let's start. So this is exactly what you need to be doing all the time. So remember what we were doing here. I'll slow it down slightly. This was the high, the all-time high breakout. Broke it. There we go. So as each of these days is progressing, you're now saying, okay, here's my low. Oh, wrong one, sorry. Here's my low. Because that was the low, which led to the break of the high. The high here. And so this is how you would actually chart it as it goes live. So you're constantly looking for highs and lows. So as we stand today, let's imagine this was the current break, you would have it drawn like this. There's my low, here's my high, and what I would do is for your lows, I would set them not as this, as some differentiator, a different color. I prefer to use a different line. So the dashed line means it's not confirmed as the market structure low. This one's confirmed because we've broken the structure bullishly. This one's unconfirmed because we haven't broken it yet. But this is the best one we have to go off. So we're basically half confirmed. So we wait. How does it progress? Well, we get that other down day which you mentioned, then it breaks. Okay, so then we got this down day and then it broke. So we know that we were wrong here. Doesn't matter, we weren't trading it. But then we can move this. And there we go. Now we're developing market structure. As we go, each day then, let me see, when you get a down close day, there, each time you get a red day or a down close day, you want to set a potential high. You say, okay, here's our potential high. Or sorry, this is our high because we've had a down close day. So this is definitely the high. Because we had a down close day, the only thing that can happen is for it to break, okay? Because we had green, green, red day. So we've got our definite high and we've got our potential low, which is the white candle. And we set it dash because it's not confirmed yet. This needs to break the orange line for it to confirm, and so you let it continue. There we go, it breaks. As soon as it breaks, and it breaks and closes, of course, which it does on this. These are daily candles. There's our new low, and now we're waiting for a new high to form. So there's a high, there's a high, there's a big red candle, white candle on my chart, but a red day. So we know this is definitely our high. This is potentially our low, but remember it can come all the way down. So dash line, it can come all the way down to here and still retain bullish structure. But this potentially is our low, a massive wick on it. We'd expect that probably to hold, and then we just let it play on. Does it hold? Yes, it does. There we go. Another break in structure. And so we can confirm this one as our new bullish level and let it play on until we get another high, which is as soon as we have a down day, there's a down day. We set our high again. And then we move on. We continually set our potential lows. And we let it play out. We had a big drop there, so we move our low down to here. It's still only a potential low, because of course we don't have a break yet in structure, but we're also still bullish. Structure hasn't broken. And you can see now that the trend of momentum upwards has ended, and we're setting new lows. So we set a new low here. So this is our new potential low. Again, hasn't broken the overall market structure, so we're still in an uptrend, just in more of a choppy period. But nothing matters until this high gets broken. Then we'll find our new market structure level. Let's see when we get one. There we do. We get a massive God candle that breaks through all the structure. So this was not our low. Turns out this was. This is the last down daily close candle before the break in structure. This now becomes our market structure level, 37k, and that's the next level to look out for a potential shift in trend. So that's going to frame live how you actually update your highs and lows as we go along. So then we want to look at market structure when it actually does break. So we'll continue. I'll speed it up a little. Let it play through. Right through until April. So here we go now. And you can see the first signs of market structure breaking. So as we continue, you can see that we broke through here. We set a high and we had a new low. So this was the high. Actually, I don't need to drag it that far because we broke it pretty quick. This was the high, this was the low. Just here. And then we broke above. This is potential low, sorry. And then we broke above the orange line here. So we had this low, which led to us breaking with the orange line, but we didn't close above it. So that doesn't count as a structure break. That just counts as, you can imagine that as a deviation or a liquidity run or whatever. And then we set a couple more lows, and then we do break it. We get a close above that line. So this becomes our market structure level here. All right. This becomes our market structure level. and we immediately come back down. We wick below it, but again, it doesn't close below, so that's not a bearish break in structure yet, but it's a sign that things are weakening. If you remember, this entire trend up, we never had any touches or breaks or anything even close to break in structure. Now we're getting a little bit more choppy. So that should be a first warning sign, and that's applicable on all time frames. So this was our new high, which is here. And this was the low that led to the break. So we now move our structure. And we have these up candles, which leads to here. So we know that was a confirmed one. This is our new high. We have this down candle, which leads to the break again. So this is our new structure here. It's the low, down close candle low that leads to the break. So even though this next daily went slightly below it, because it didn't close below it, that's just a stop run, sweeping liquidity, whatever you want to call it. It's the down close candle level that matters. Then we break through and we set another one all the way up to here. And another down close candle, which leads to the highest high of this push. So we can see that our final market structure level was there. Then, what do we get? We get a couple of big candles down that break through all of these yellow lines. So really, once the first one breaks and actually closes, you consider that uptrend over. And it breaks down, leads to a bit of a downtrend, choppy, sideways period. But this is your first signal that the trend has shifted. So on a daily chart, the trend has absolutely shifted bearish, okay? Now, normally what you would expect to happen is as soon as these daily up close candles, as soon as you get that there, that first one, like here, first one that breaks down, you'd expect that to be the start of a downtrend per the Dow theory I mentioned to you. But of course, markets don't move like that in such a simple sense. What we've seen, and obviously we're using this in hindsight, and you can, I'm sure everyone remembers what happened here. And I'll just clear some of this so it's a bit more easy to see. What we then went into was basically a rounded top distribution pattern, where we briefly went above this high, we continued to distribute. So don't get mixed up in the fact that a price can still make another new high after breaking structure, but what's happening is the momentum's weakening, and we know that this is about to head to the downside. All right. The main thing is on the big uptrend that we've seen, even with the crazy volatile days like these, it still never broke structure. That signaled a continuation, and this was a true continuation, a big continuation leg. Then we did break structure, and the next push was much weaker, grinded up instead of blasting up, and barely made a new high before reversing. So in terms of market structure, we then want to go back and look, or what you could do on this would be to look at a higher time frame and see how the structure is developing there. Because on a daily time frame, we can see that market structure is breaking. So then we go to our next highest time frame, which for me would be the 3-day. So I like to go daily, 3-day, 1 week, if I'm on my super high time frame charts. And if you're looking at it, essentially what you're seeing is the structure hasn't broken here, okay? Because you got your low, which led to the break of all these highs. Right, then you set another low here, which led to this break here. All right, so there was the high, and the low was here. So on a 3-day chart, you'd say, if you asked me, I'd say, oh well, uptrend is intact, and we're setting a low here, and we're potentially going to break it again, and we're going to keep the uptrend going. But the value of what you were doing previously on the 1-day chart is you can say, oh, the 1-day chart structure is breaking, 3-day chart is lagging. It's more likely that the 1-day leads into the 3-day breaking now than it does into a continuation of the trend. So that's why when I say in terms of scalping, which we'll get into in a moment. You want to frame your market structure and trading from high time frame to low, and look first of all at, let's say, an hourly chart for your market structure. Then go into the 15-minute chart, because you'll see the breaks and structure sooner, and then execute on the 5-minute or the 1 minute to get a tighter entry. So as you can see on this 3-day chart, it hasn't broken yet, but the 1-day chart gives you a clue that it is breaking or likely to break. And so you could be looking at this and framing this from a different perspective. You could be looking at what we're seeing here and saying, hold on a minute, doesn't this look like we're setting a high? We swept out the high, and we're potentially setting another lower high. So head and shoulders, an over-under pattern, whatever you want to call it. So you could be looking at this instead of the perma bull who just thinks, oh, we're in a continuous uptrend, we've not broken structure yet. You could be saying, well, actually, I'm looking at this on the daily, which is only one time frame lower, and the daily is still very significant. You could say, well, look, here's one high, or sorry, here's one low that led to this high here, which has already been broken. We're getting, by here, it's confirmed broken because it closes below it. So you could say, all right, I'm seeing all this developing on the daily, but if I go back to the 3-day, people still think we're bullish. So you potentially can get a bit of an edge on those people who are focusing on the super high time frames, the daily, 3-day, or the weekly, and you can front run them. This becomes more relevant on the low time frames when you get into scalping. That's how scalpers can spot a shift in trend much quicker than a swing trader. So you could be potentially setting up and looking for shorts here, and you know, in hindsight, you'd already be in one because you can see this run over the highs. You can see all these wicks above. We're clearly getting pushed down each time. You could be entering shorts targeting this low, and then targeting the market structure on the 3-day, which is down here. And so you could potentially have been short from the high 50s, made one more push higher. Then we had the big break, and that's gone a little bit too fast, but we'll see. From here, so from this point, whenever these big candles come down on a 1-day, you say, okay, as soon as we broke, technically here, as soon as we broke that 53, daily structure was broke. And you can say, okay, daily structure's broke. I'm going to start looking at this as a possible distribution, start looking for shorts, whatever you want to call it. So that then you'd be looking, instead of looking for bullish setups, you'd be looking for, okay, each time we set a high, how are we reacting when we take it? So we took a high, we come back down. We took this high, we came back down. Big drop off. You're like, right, okay, this is definitely distribution. I should be looking for shorts. And you can frame your bias that way. You can see here, this down close candle offered a really good trade. And let me show you. Let me clear this all actually and show you the most relevant use of market structure, which is for forward-looking trades. It's not going to be something that you enter right away, but if you see after we have a big breakdown like this one, where it's pretty clear now that we're starting a downtrend, the market structure can help you frame your entry. So you can see there the low, which led to the highest high, which is here. So this high, this low swept it. So this was technically on this uptrend here, this was the market structure level. We then broke down through that. So confirmed breaking structure. We're looking at a trend shift. That means we want to short the revisit to this level, because typically what should happen is we get a retest, which we did. See here, these are daily candles, so you got 2 opportunities in 3 days to potentially get a short on, you know, with a stop loss above the high, of course, and then ride that. Obviously, it was a really good trade in hindsight. So that's kind of the higher level overview of market structure. And I want to go down and take it even more. Just wanted to show the market structure break for April of 2021, the big macro top, show you that market structure works on a macro level. All you had to do, oh, and this is an important point. So what I've been doing to now is showing you market structure as it develops. That doesn't mean that you have to take trades as it develops, okay? You can wait, and you should wait. As a trader, you should be reactionary, not predictive. Being predictive is for investing. You say, I'm going to buy Bitcoin now because I believe in 5 years' time it will be higher. That's predicting. As a trader, you want to say, I am going to wait for the market to make a move, and then I am going to make my decision based upon that. I'm going to react rather than anticipate, okay? So the right way to play this, and remember this for future, is to be constantly marking your market structure, marking your highs, and wait for the big break. There will always be a big break, and we got it here. This very clear, massive break in market structure, all right? And then what you're doing is saying, okay, we've broken this structure, we ran a high. Clearly now, market structure has shifted bearishly, and we want to short the retest. So you wait for the retest to come, you set your alerts, and you go short. Set your stop above the high, and then you, whatever target you have, some of these, I would say your target should be this one, pretty obviously. So there will be your target. So we put in green for short, because we broke down all the way to here. We done the retest here, and so if it's going to continue a downtrend, what's going to happen? It's going to make a lower low. So you have high to lower high. It needs to at least go below the green line to continue the downtrend. So then you get your market structure too low, or market structure, you get your position too low. You know this already. You know this is the level. You know this is the high, and you know this is the low. Because remember, you're placing this trade anywhere within this price action. Because you've had the break, you're waiting for the retest. So you can just blindly set your entry there. You can set your stop loss above the high. You already know where your target is, which is here. Do you have a trade that's potentially profitable? It's over 2 hour. I would consider that, yes. That's how you use market structure to the greatest effect. So now let's look at it on a low time frame. And so we'll exit this replay mode, and we'll go back to, let me see, where's a good example? This little uptrend is a pretty good example. So I'll go to a lower time frame. Whoa. Didn't mean to do that. Back we go. It should be 1H, not H1. That's why I'm getting myself confused. There we go. Now, so what we're looking at was this uptrend here. This is a nice example of an uptrend on an hourly chart. And this is exactly how you would trade it as a scalper. All right. So you can see, I'm going to go through these very quickly because you're aware by now. You should be aware by now of the levels I'm talking about. So I'm going to pick it up here because we've got a key high. Right, there's a key high. Sorry, to keep it consistent, I'm going to use the orange line for the key highs. So there. And so for me, zooming out, in this potential downtrend, as we're chopping along here, we do this high, and we're grinding up to this level. I wouldn't consider any of this to be an uptrend yet. Obviously, in hindsight, when you look back, it's higher highs and higher lows. But until this level broke, it wasn't a confirmed uptrend, okay? Because we had the drop down. If this hypothetically had reversed here and came back down there, then you're just in a choppy range. You're not trending. You break there, then you are trending on low time frame. So this is the key level. And that's where you always want to have your frame of your bias. If I look at it on a live chart for right now today, because it's obviously harder, it's easier, sorry, when you're looking at hindsight and looking back. The same thing's happening here. I wouldn't consider us in an uptrend on the 1 hour chart until we break this high, because anything that happens between now and then can just be a corrective bounce, which leads to a new low. See that? Continuation of downtrend. If, like we did here, if we can come up, all the way up to this level, and then break it, okay, well then I'm looking higher, and I'm looking at this high, because then we're in an uptrend, we're looking at market structure to continue to break bullishly till we take out one of the key highs, and then maybe it reverses from there, or maybe we go for the next highest level. So that's, if you're imagining this big drop here, compare it to this here, right? Big drop, consolidation. Nothing until the high of the big drop, nothing until that key high gets broken, nothing matters. It's still a downtrend. Doesn't mean you can't go long. Of course you can go long, you can trade it. But from a trending perspective, you need to wait for that high to get taken, and then you can take some of these nice market structure trade setups. So let's get to the 1 hour chart and get really granular with it and see how you would trade it as a scalper. See if your key high, it gets broken here, right, on this up candle. So we go and find our down close, which is there. And now we have our market structure for the hourly, right? And that sets a high up here. What do? Exactly what we were doing before, because markets are fractal in nature. The same principles apply on all time frames. This is our new high. And just for the purpose of this, I'll keep deleting the old highs just a bit cleaner. We still have our market structure low here, but we've set our high. So now we wait, is it going to break? So as this was developing, I'd have set this as my low, potentially, but then we got another down candle. So no, on a 1 hour chart, our low is constantly changing. Here's a low that looks like it's going to break all the way. This would have been our potential low, but no, pulls back. As you can see, eventually, this isn't a break because it just wicks it. Eventually, this down close candle leads to the break. So we set it here. That's our new market structure level. All right. Then we have set a high up here. And let me see. Set this high. And there. We then set some lows. We set a low here, but doesn't close through it. It has to close through the high. So that is not a new higher high yet. We then get a breakdown like this and a sweep and a big break. So this low is the down close candle that led to it. We had a big sweep of all the liquidity as well. So that's our new market structure level. If you want, you can set your market structure level to here. It's kind of a personal preference thing. This would be the level below which I would start getting bearish. This would be the level I would trade if I was trying to trade a liquidation run, because obviously the stops are going to be resting below here, right? So it's up to you. Both are applicable. So if you want, you can have it as there. I tend to do this from a trading perspective. I set the lows like that. But from a strict market structure perspective, it's about the close candles. Because if you watch this, let me show you. If I switch this to a line chart, you can see here, that's the level, all right? So the candlesticks can lie sometimes. So if you're looking at an overall trend versus trading stop hunts or liquidation runs, you can see there's a little bit of a difference in the two. Anyway, we set a new high and we come back down. So we set a high here. And then we come back down. Remember, we haven't broken our structure at all. We're just waiting for the next break. There we go. Big break through it. So our down close candle is this one. Down close candle, which led to the break. And there's our market structure level. Now, you can see how in this move coming up, you're about to get a much better entry on a short than somebody trading on a higher time frame or somebody who's waiting for whatever more confirmation they need. Because you're using market structure intelligently, you know that this break up here sets a high, very obvious high here. We then set a low, set lows, set lows, set lows. This one closes through it. All right, we're zooming right in. This down candle, because it closes through, consider that a break. There's our new market structure level. It now sets a high here. it goes up, sets that high, and then down. It actually sets the low as well. So the market structure moves to here. Down close candle, which led to the highest high of all, which is up here. So we've finally got our highest high. Obviously at the time we don't know that, so we're just marking it as normal. Can remove this one, can remove this one. I can remove this because our market structure level has moved up. Now, let's try and visualize it. Low to high to low to high. Then we break down through it, okay? And so we close through the line. As soon as this hourly candle closed below the previous market structure level, we are saying trend has shifted. So trend that was going up all the way has now taken a break like this. What do we look for in that sense? In that instance, we look for the level at which the market structure broke from. So we look for the yellow line, which is on this example, it's there. We look for a retest of that level and then some weakness there to get short. You can either blindly short it with a stop above the high, which is a fairly good success rate, or you can use some lower time frame patterns, which we'll talk about in a later module, to get a better entry. But for now, we're sticking with the high level view of market structure. So this candle here was the break in structure. We then immediately bounce back up above this line and we start to chop around. But essentially, at this point, per your rules, you know that on the hourly chart, market structure is broken, so you should be looking for shorts. And so you get, as you can see, you get many great entries for shorts, and eventually, this small little break in the hourly leads to the total break across all time frames and an extended downtrend all the way to, where did we end up on this one? Right where we are now. So you can see the power of focusing on market structure. Now, you would not execute, I would not recommend anyone executes on the 1 hour chart break like this and then holds a short all the way to 36K. That's completely contrary to what I told you earlier. But you can see the power of it. You can see how the low time frame market structure leads to the high time frame. It's very, very much common sense. People think that the most accurate way to view a market is on a daily chart or even a 4 hour chart or whatever. The most accurate way to view a market is on the 1 minute chart because it's easier to predict what's going to happen in the next 5 minutes than it is to predict the next 5 days. That makes sense? And also, if you're going to have a break in daily structure, you must, by definition, you must have a break in 4 hour, 1 hour, 15 minute, 5 minute, 1 minute. They must all break before the daily can break. So if you're trying to get a better entry, you go to the lower time frames. So that's overview of market structure, and you can see how it leads. And as soon as it breaks, you are at a very high probability of being at the forefront or at the edge of a new trend, where you can then capitalize, get short before other people realize, and make money. Or vice versa, long, you can spot bottoms before other people spot the bottoms. So that's the market structure module complete. After this, we're going to go into the more the confluence factors you want to add to your market structure, which is going to be the things that can tell you and help you to get a better entry on these charts. All right. There's any number of them. I prefer a specific pattern called the over-under and the over-under-over, which you've probably heard of, but we'll go into much more depth in. But also, I'll cover a lot of different things so that you can find tools to help you spot, after the structure break, spot a good entry for your short, your long, or whatever. And also focus on how to set your targets for entries and exits. Specifically, where you should exit your shorts based on market structure. All right, so the obvious answer to this is key highs and key lows, but we want to look at some lower time frames as well, because not always, you're not always going to go short and target the key daily low. You want to target some interim lows at 1 hour, 4 hour charts or whatever that you think some liquidity can be resting beneath or resting above if you're going long. And that's what the next module is going to be, all about liquidity and how to spot where it is, how to spot potential manipulations, as in running of highs and running of lows, and then also, of course, how to trade it. So, jump into Module 2 soon.